If you have gilts in your portfolio, in your pension, your ISA, or wherever, you're probably hurting a bit right now. So, should you sell? Hi and welcome back to the channel. My name is Pete Matthew and I'm a chartered financial planner based here in the UK. And the answer to the question is no, you probably shouldn't sell your gilts right now. But let me give you some context for that. First, we need to define what gilts are and why they are problematic right now. When the UK government needs to borrow money, because it is spending more than it earns in tax takes, it issues a bond. Companies do the same. But because this is the UK government, the Treasury, they are deemed to be very safe loans to investors. They are gilt-edged in their quality and hence the name gilts. Now a bond is simply an IOU from a company, or in this case a government, to you as an investor. So let's say I agree to lend the UK government £1,000. I get an IOU that says HM Treasury owes me that money. And on that IOU are two other pieces of information. One is the interest rate. So let's say it's 4%. So the Treasury will pay me £40 a year in interest, 4% of £1,000, for as long as the debt remains outstanding. And the other piece of info on there is the redemption date, when they will pay me back, give me back my £1,000 that I've lent them. So let's just say that's 2030, 8 years from now. So far, so simple. But these IOUs are themselves traded on the stock market. So let's say over here there's a pension scheme that wants to lock in £40 a year of income for one of its pensioners. Well, they might be prepared to pay me, say, £1,200 for that guaranteed income stream. So I've made a £200 profit on my £1,000 gilt, and now HM Treasury owes the pension scheme, not me. They now have the IOU. But even though the interest rate, which is really called the coupon, of the gilt is 4%, that doesn't mean that the pension scheme gets 4% of the £1,200 that they paid me. No, they still get the 40 quid a year because the coupon is based on the nominal value of the gilt, the £1,000 that it represents. So actually the scheme's actual yield, if you like, is 3.3% because that's what £40 divided into 1,200 gets you. And that's why yields are the inverse of prices. It might sound a good thing when you hear on the news that gilt yields have gone up, but simply means that prices have gone down and that's tough for investors. And generally, gilts with long durations, long time scales until you get your money back, tend to be more affected by market factors like inflation than shorter term gilts do. And actually, that's another problem, particularly right now. There's loads of parts to this, so I'll try and be quick and cover off the main ones. But in periods of high inflation, such as we're experiencing right now, income which is fixed, like the interest paid on a gilt, becomes less valuable over time. So in our example, that £40 a year, that's going to buy a lot less in a few years' time than it does now. And so investors tend to sell gilts in times like these, or at least don't buy so many of them, and that pushes down prices further. Now we all know that risk in a portfolio is classically linked to the proportion of shares in it. Now bonds, such as the gilts that we're talking about, are used usually as balancing assets to shares. So a cautious, low-risk investor might actually be holding quite a large proportion of gilts and other bonds, and despite them being technically low risk, they're probably looking at pretty substantial losses right now. Now at the same time, for many people, their pension funds will be set to something called a lifestyling approach. So the thinking here is that as you approach retirement, you might want to take less risk, and so the pension scheme gradually moves from equities and into bonds and cash, the nearer you get to whatever your chosen retirement date is. And that happens automatically. That sounds like it ought to be a good thing, but really it's a carryover from when most people bought an annuity with their accumulated pension fund at retirement. Buying an annuity is a one-off cash event, and you want your fund to be as much as possible. So the last thing you would want was a market fall just before you bought your annuity. So it definitely made sense to shift out of shares and into bonds as that day approached. I met somebody the other day who has absolutely no intention of touching his pension fund anytime soon, but discovered, to his horror, that the pension had been lifestyled, so that 60% of the fund up to now has been shifted into long duration gilts and cash. And the gilts element of the fund is down 40% over the past year. By any measure, that is painful. So if you're a cautious investor, or if your pension is being lifestyled, you've probably taken a hit this year. So, should you sell your gilts, maybe buy equities instead? Or do you buy something else? Surely anything is better than what you're experiencing right now. Well, before I answer that, if this is useful so far, do me a favor, hit the like button, subscribe to the channel if you're not already. It really does help, so thank you in advance for doing that. Should you sell your gilts and buy into something else? Well, I think actually you should wait. And I think you should think very carefully before selling completely out of gilts and into something else. And there are a few reasons why. Firstly, one of the big factors affecting gilts right now, that's high inflation, is likely to be relatively short-lived. So yeah, it might be a year or two before things approach any kind of normality, but in investment terms, that's just the blink of an eye in the context of an investing career of multiple decades. I have no idea if gilts will recover their prices from a year or so ago, and if they do, how long they'll take. One thing is for sure though, things are going to be volatile for a while yet, for all kinds of reasons. Just before I hit record now, the UK Chancellor of the Exchequer, Kwasi Kwarteng, has been sacked, replaced by Jeremy Hunt. There are still loads of questions about whether the so-called mini-budget from 2 or 3 weeks ago is going to be revoked, either in part or in full, and how markets will react to that. We're still recovering, really, from the lockdowns of 2020 and 2021. Energy prices are impacting everything, and clearly that's not helped in the least by the ongoing travesty and tragedy in the Ukraine. Changing investment approaches in volatile times is rarely a good idea. Holding a watching brief makes far more sense. And I would only do that if there is a real need to change your investment approach. Those kind of changes of direction usually only become necessary because of some life change or other, something going on with you, not because of external circumstances which are outside of our control. So if you're not experiencing a life event that requires you to look at your investment mix, then best to leave things as they are and consider all of this unpleasantness as a fairly transitory, bumpy patch in a very long investing road. Now, if you haven't watched the video from a couple of weeks ago, then do so. I'll link it up here and I'll put a link in the description as well. But in that video, I asked the question, what exactly are you going to do to make any material difference to your portfolio right now? And I think that's the question we should always ask ourselves before we act. Gilts are down. So are you going to buy, I don't know, gold instead? Gold is safe, surely. People often buy gold in volatile times, don't they? Particularly when inflation is high. Well, gold is near its highest price in 20 years in sterling terms. So to sell gilts and buy gold is selling low and buying high. That's the very opposite of what investing is all about. So please, don't do that. In fact, don't make any changes unless you really have to. I know that it's difficult when you feel like you should be doing something, but nothing is usually the best course of action, and particularly while things are still very much up in the air. I hope that was helpful. There are plenty of people who will do a much better job than me of explaining the more subtle nuances and the complex details of what is going on right now and why. But I find that a simple explanation and a little bit of calming common sense goes down well with my clients, and I hope you find it useful too. If it does, then hit the like button and subscribe to the channel if you're not already. And if you've got any comments or questions, then leave them in the comment section below the video. I'll do my very best to answer them. But thank you for watching this one. I'll see you next time.